and thank you for joining us for this week's market briefing. Today we will discuss the benefits of diversification and why we feel this is a prudent strategy for investors with today's uncertain global economic outlook. We hope to provide some general perspective on how different asset classes have performed historically and why having a diversified investment portfolio provides investors with a smoother experience over longer periods of time. Let's begin with taking a closer look into the periodic table of investments shown here. This chart shows performance across a wide range of different asset classes each calendar year over the last 15 years, including year-to-date for 2020 through June 30th. It is important to note that it is impossible to pick the top-performing asset class from one year to the next. For example, fixed income was one of the bottom-performing asset classes in 2019, but is the top-performing asset class year-to-date in 2020. Conversely, REITs are struggling in 2020 despite being a top performer last year. With this in mind, diversification amongst asset classes opens up an investor's opportunity for a positive return experience. The line and white box in the middle of the chart represents a diversified portfolio of the asset classes included in the table. You will notice that it never reaches the top or the bottom, which is exactly how it is expected to perform. Despite the difficulty for investors throughout the last 15 years, which has included two of the worst equity bear markets in history, the diversified portfolio was still able to achieve a return in the mid-single digits and has also significantly outperformed cash. Diversification, along with time, also helps reduce volatility and smooth out the investor experience. If your time horizon is short, almost anything can happen within the stock and bond markets. As shown on the chart, with a one-year time horizon, there is quite a large range of return outcomes. As you increase the time horizon, the range of returns shrinks in size and also skewed more positive. The simple diversified portfolio of 50% stocks and 50% bonds, shown in the gray bar, has a tighter range of returns than either 100% stocks or 100% bonds over all time periods. The more time you have and the more diverse your portfolio is, there will be less risk in the long run for experiencing excess volatility or negative return potential. Given the extraordinary disruption to the U.S. and global economies during 2020, it is remarkable how well financial markets have held up. However, investors should not be complacent following the run-up in stocks from the bottom in March. Time should help alleviate some of the uncertainty around the production of a vaccine for COVID-19, as well as how the U.S. and the rest of the world economies will respond to the second wave of cases that have emerged this summer. With all of the uncertainties we are facing right now, RMB feels that investors should maintain a diversified stance in line with their long-term allocation targets. This has been one of the most difficult and unusual years in modern history. It is important to remember that staying invested over difficult periods is better than sitting on the sidelines waiting for the market to calm, which may not happen anytime soon. From all of us here at RMB, thanks for tuning in. We hope you are able to join us for our next market briefing.